welcome to On the Money. My name is Cynthia DeFazio, and I'm joined today by Ryan Wheless and Peter Lott of Allied Wealth. Ryan, how are you today?
I am doing so well, Cynthia. It's great to be here with you.
It's great to see you again. Peter, how are you?
I'm great. Thank you, Cynthia. Excited to be back for sure.
I'm excited to have you both in the studio because obviously I know how incredibly busy you are. You're both so passionate about delivering information to the viewing audience. People have so many questions about how to plan properly for retirement. Ryan, what types of questions are you hearing a lot in the office right now?
People are really concerned about all that's going on with the stock market volatility.
Yeah.
There's just so much happening. One day we're up 800 points, the next day we're down 800 points. And the reality is people are having that concern because they're worried about losing money and losing their security, their peace of mind in retirement. And it's just one of those things where people are, they're scared. And, you know, the news is so crazy because all they do is get you all excited and revved up and concerned. And, you know, people call our office and go, well, hey, I'm losing all this money in my portfolio, Ryan. What's going on? I'm like, well, have you looked at your portfolio lately, or are you just watching the news to kind of see what's going on in the world?
Yeah.
Because if you pull up your portfolio with us, you're probably not down anywhere near what the markets are.
I've seen that. People are down 12, 13%, and we're down just a fraction of that. And my clients feel good knowing that, but the people that are calling in that are experiencing this, they're just going through the whirlwinds of the market, and that volatility is just killing them. You know, they're seeing their accounts just plummet where they're not used to it. They've been on this long bull run for almost a decade, over a decade right now. And now they're starting to see the volatility show up, and they're starting to see maybe the cracks in the economy starting to show, and they want to make changes. So we're seeing that daily.
And I mean, they're getting closer to retirement too. They're getting closer to the point where they need these dollars to generate the income they want to have the lifestyle they want to live in retirement. And when you start seeing returns go down, the markets go crazy, you begin to lose your peace of mind and your sense of security. And see, that's one of the things that we do so well at Allied Wealth is that, you know, your investment portfolio's return is an integral piece of your overall financial plan, but it's only a part of it. So when people are calling in and they're concerned that our clients, even though we are down way less than the markets this year, you know, one of the things we do is say, listen, remember something, you're trying to live the next 30 to 40 years without a paycheck and not run out of money in the process. And we've got a long way to go. So to kind of help ease things, let's go back to your plan. And remember, at Allied Wealth, we base everything on probability of success. So even though your portfolio's down slightly this year, your probability of success has gone from 85% to 84%. Well, guess what? If your probability of long-term success is 84%, you're going to be just fine.
I'm okay with that.
I'm okay with that.
You know, and the thing is about that is we've already planned for that. When you come on as a client, we've planned for these days to happen. We've seen these before. We're gonna experience it, and we plan for it. So in your plan, you've got what happens when the bottom falls out. How are you protected? What investments do you have that is going to protect when those days come? Because we know they're going to happen.
They're going to happen.
They're going to happen.
Jack Bogle himself, the founder of Vanguard, he would be the godfather of index funds, if you will, came out, you know, what, 5 or 6 years ago and said, if you're age 60 or around age 60, you will experience 3 to 4 market crashes like 2008, 2009 in your golden years.
Wow.
So we know it's coming, and if we know it's coming, we could help protect from that downside. But the most important way to do that is to understand that the overall portfolio and the return of the portfolio is a small piece of the overall plan. There's a lot more to it than just that.
Ryan, and if you look at it, you know, if you're one of these people that's taking on a lot of volatility and your money, the accounts are up, down, well, you're taking income distributions from that. Typically, let's say 4 or 5%. Let's say you've got $1 million, you're taking a 5% annual income distribution. That's 50 grand a year. Well, let's just say for simple math, it fell down to $500,000.
Wow.
What's your income now at 5%? It's $25,000. I know that's a big. I just wanted to show you easy math.
Pete, I thought that was a paper loss.
Right?
It is until you're taking income and you need to live off this money. Now it's not a paper loss anymore, and those are the days that you start to panic because you don't have that paycheck anymore, and it's tough to live like that, knowing that no matter what you do, how you live your life, your portfolio is going to be affected by geopolitical risk. It's going to be affected by inflation, volatility, all these headwinds that you have. It's a tough road to travel for sure if you don't know what you're doing.
And Cynthia, the thing about the market downturns is that I think they're magnified by the drama level in the news.
Of course.
All right. So if the news
That is
drama
true.
is super high, and there's wars going on and oil spiking and, there's talks of inflation and the Fed's raising rates and all these things are happening, the reality is that people get even more caught up in it. But there's a couple of interesting facts I think the viewers at home should know about.
Okay.
One of which, the markets are down 5% or more about 3 times per year on average.
Okay.
And the recovery period or time from peak to trough is about 43 days. And then the markets are down 10% or more about once a year. So once every year, the markets are down about where you are now. And it's interesting because depending on what's being said on the news, it dictates how many calls we do or don't get on the show or do or don't get at the office.
That is interesting.
Right? And then the recovery time when you're down 10% or more a year is around 112 days. So it's very common to have these periods of market volatility, but I think the folks at home are getting pretty rattled by the news media,
They are.
Yes.
and they're not connected to their financial plan.
Yeah, absolutely. Well, I have to ask you, what are some steps that you can use that would be guardrails, if you will, with someone's portfolio and their financial plan?
Yeah, I mean, a good thing to do if you have a portfolio is, I think, first and foremost, get a second opinion of it.
Okay.
Let somebody else take a look at it and see. We call it a portfolio X-ray. Let us see the bones of this thing and how it's going to perform. Because what a lot of advisors they don't tell you, they don't want to talk about is how much risk is this really carrying? If you were to put this portfolio in a pandemic or COVID or a 2008 financial crisis situation, what kind of losses have you seen from that? They don't talk about that. So you want to know it's called drawdown. You want to know what the drawdown is. You want to know what that metric is. We can real quickly and easily figure that out. And hey, I could never afford to lose 30% of my life savings in this portfolio. I need to make a change.
And
Okay.
Pete, how do most people find that out? What their drawdown is?
Experience.
Right. They don't have any idea how much risk they're
Until
taking.
they're sitting there
And all of a
they're
sudden,
down.
they see it happen. Remember the COVID crash? It happened so fast. So many people were in portfolios that they had no idea how far those portfolios could drop and how fast they could drop until it actually happened.
Yeah.
And then that's a terrible thing because there's a whole subject matter out there about behavioral finance. And what that could lead to people doing is actually selling at the bottom and never getting back into markets. And they lock in that loss. They never capture the upside. And largely that's because 2 things. One, they don't understand the risk in their portfolios. And the second thing is they don't understand how their portfolio fits into an overall comprehensive financial plan. And there's a big difference between just having those 2 things connected together and just having an account statement come in the mailbox and going, hey, you're up or down this week.
Absolutely. Well, Ryan, I know that you and Peter have a very special offer to present to the viewers at home. Why don't we talk a little bit about what that is and then open the phone lines?
Absolutely. So folks at home, we're offering a financial flight plan. And my background is aviation, and there's so much planning that goes into putting an airplane into the sky. There's so many things we have to plan around. And we take that planning, we put it over into the retirement world, and we focus on some very important things. The first thing is your risk capacity. So many people focus on risk tolerance. I don't like risk tolerance because that's what you think you can afford to lose. Risk capacity is what you can actually lose and still maintain the lifestyle you want to live in retirement. The next thing we do is build an investment plan based around your risk capacity. And after that, we're going to build you an income plan. A solid income plan should allow you to spend money in your golden years with confidence, even in down markets. The next thing we're going to do is look at your tax situation, because I personally believe taxes are actually a bigger expense in retirement than healthcare is. So if I can help you mitigate your tax liability, your dollars will go much further. The next thing we're going to do is look at your healthcare plan and make sure you're adequately covered. And finally, folks, we're going to look at your legacy plan. What are you going to leave behind? And the most important thing we're going to do is look at leaving money behind to where Thanksgivings, when you're not there, you're dead and gone, are not awkward for the remaining family, right? People are still love each other. Nobody feels like they got the short end of the stick. And folks, that's all part of the financial flight plan. And how you get it is easy. You see a QR code on the bottom of the screen. Click that QR code. That'll take you to a page where you can put in your information, and we will contact you shortly. Or you can call 844-944-7555. Again, 844-944-7555. And you could reach us at onthemoneytv.com. Lots of ways to get in touch, folks.
Ryan, thank you so much. Peter, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 844-944-7555. We know you have a lot of questions for Ryan and Peter about how to plan your perfect retirement. They have the answers for you. We're going to take a very short commercial break, but don't go anywhere. When we come back, we're going to talk more about the stock market, so stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go? And who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to On the Money. My name is Cynthia DeFazio, and I'm joined today by Ryan Wheless and Peter Lott of Allied Wealth. Gentlemen, a wonderful show that we're having today, talking about such an important topic, of course, the stock market. Everyone has questions and concerns, and like you mentioned, they've enjoyed this strong run for so long. So, Ryan, what else should we be thinking about when it comes to portfolios and the stock market in general when someone's entering retirement?
The biggest thing, Cynthia, is the amount of risk that you're taking. But what's mind-boggling to me is that that's not how people select portfolios. It's all about the return, right? And I think you should focus on the risk because just like Pete and I just said, most people don't know what the risk is until they actually experience it.
Yeah.
Right?
You know, that's the thing. Chasing returns is a trap.
No question.
You're going to get in that trap at some point, and then you're way down, and then you're stuck, right? I mean, it's hard to get out.
And here's the way to look at it, Cynthia. I've got 3 investment options, all right?
Okay.
Investment A, B, and C. Investment A has a 10% return. Investment B has a 10% return. And investment C has a 10% return. Which investment's best for you?
Can I phone a friend?
Absolutely.
I mean, the answer is you don't know. And so some people would say, okay, if I had to pick of the 3, I might put some money in A, some money in B, and some money in C.
Yeah.
Well, what if I told you that investment A had a 20% downside risk number, and investment B has a 15% downside risk number, and investment C has a 5% downside risk number? Which one would you go with?
C.
C.
Yep, absolutely.
Always.
Let's take
Answer C. It's
Didn't even have to phone a friend. That was easy.
And so, and that is really what matters the most when picking investment portfolios. And there are mutual funds and separately managed accounts, all these different things out there to invest in, and they may all have 10% returns. And that's great. But what's the downside? What is the downside? Because if you have $1 million and your portfolio goes up from $1 million to $1.3 million, is that going to change your lifestyle?
Absolutely no.
I don't, yeah.
It'll change.
You might travel a little bit more.
Yeah, just
but
a little.
You're not going to go start chartering private jets and spending summers in Monaco, right?
Right.
You know, but if your portfolio goes from $1 million down 30% to $700,000,
Yeah.
I can promise you your financial peace of mind and security has gone out the window, and you're absolutely thinking about change in your retirement lifestyle.
Yep.
Sure.
Right?
Yep.
Sure.
So what we do at Allied Wealth for our client base and our prospective clients is we look at the portfolio in a sense of I want to focus on mitigating your downside risk first. How do I do that first? And let's focus on getting returns second, because the people that call our show have done their part. They've done a good job saving. They're saving, $1, $2, $3, $4, $5 million. They're engineers, they're old execs, they work for tech companies or in the healthcare space, they're lawyers or doctors. We help them all in that area, but the reality is that they've already done well. Our job is to keep them doing well, right? I want to grow the money for inflation. I want to help mitigate tax liability. I don't want any major downturns, and I want them to be able to go out into retirement and spend money with confidence, even though there's some guy on the nightly news talking about how the world's going to end tomorrow.
Yeah. Absolutely. It's all about peace of mind, especially in retirement. Like we mentioned earlier, obviously, when you're younger, you have time to make up your losses, but you don't when you're older, correct, Peter?
You don't, because think about that. If you take a big loss, you have to have a big return just to get back to even, right? You might need time to do that. The 08 crisis, it was what, 1,100 days before it was back to even again? That's a long time to be down, to sit there and be taking money from the account too, because that's what you're doing in retirement, you're taking income. So you've got a loss, but now you've also got the distribution taking funds out of it and hurting it as well. So you want to protect that as much as you can. It's crucial.
Absolutely. So a lot of times people don't realize the risk they're taking until it's too late. We talked about that in the first segment. So when someone comes in for their portfolio x-ray, what does that look like exactly?
So that's a great question, Cynthia. The thing is that, folks, the portfolio x-ray and our financial flight plan, it's not like some report that we just send you. It's interactive. We have to collect information from you to help build this customized plan for you. So what we want to do is look at all your statements. We would look at all your positions, all your funds, your ticker symbols, how much money you have allocated in each scenario or each position, and then what we want to do is test it. So what would your portfolio have done if we had it repeated of 2001, 2002, that back to the dot-com crisis and the terrorist attacks? What would your portfolio do in the 08, 09 scenario? What would it do in the taper tantrum, the first time the Federal Reserve Bank started talking about reducing all of the quantitative easing in money printing? That was back in 2012. And the COVID crash. And then in this recent year too, what's happened this year, right? So we want to test that. And if your portfolio drawdown is something that you're comfortable with, then great, you got something of value, and we're here to add value, right? But if it's not something you're comfortable with, we can point you in the right direction and help make some changes to get you in a situation to where you can say, okay, Ryan, I need a 7 to 10% return in my golden years, but I do not need a 30% loss. So can you put me in something that can give me a 7 to 10% return and maybe mitigate my downside risk to maybe 10%? And the answer oftentimes is we can, all right? We can do that, but you've got to pick up the phone, you've got to call, you've got to go through the x-ray, you've got to go through the process.
Absolutely. Peter, I should ask you, why is understanding standard deviation key?
Well, understanding the standard deviation when it comes to your portfolio is going to give you the metric to say, like Ryan's talking about, the good years, the bad years, what the difference is there. But you don't want a lot of data in there. You don't want a wide data mark. You want a smaller mark. You want those numbers to be closer together, because that's going to allow you to have a more consistent return over time.
Okay.
And that's going to be much better for you than having a kind of I call it the wobble factor.
Okay.
How much can this thing wobble from each side? And if it can wobble way up but also way down, well, that's bad. But if the wobble factor is a little bit tighter, that's going to be better for you over time.
And the reality too, Pete, is that standard deviation is nothing more than a measure of risk expressed in a percentage.
Okay.
The higher the percentage, the greater the risk.
Yep.
And there are portfolios out there with a 10% average return with a 16% standard deviation, which is high, okay? And there are portfolios out there with a 10% average annual return with a standard deviation that's 6, all right? And that kind of goes back to A and B and C with a 10% return.
Yep.
Portfolio C has a 5% downside, is therefore the best. But so many people buy on the performance numbers, and they don't look at the risk numbers. And they're not taught that. Nobody teaches people this. They don't talk about it. And it's such an important factor to look at the actual risk you're taking to get the return you're getting.
Yeah.
It's super important.
Absolutely. Well, Ryan, I know that you and Peter have a very special offer to present to the viewers at home. Let's talk about what that is before we reopen the phone
folks,
lines.
we're offering a financial flight plan, and what that is a comprehensive plan that allows you to know where you stand as far as risk goes. How much risk in your portfolio are you taking to get the returns you're getting? Next thing we look at is your income. Where's your income going to come from? And does your income plan allow you to go out into the world and spend money in retirement with confidence, even though the stock market may be down? Next thing we'll do after that is look at your tax situation. Taxes are going up. It is going to happen. And your majority of your money is probably in an IRA account or a pension account, all of which is taxable. If I can help you reduce taxes, I can help you take less risk and help your money go much further. So folks, there's so much more to it, but those are some basic elements of the financial flight plan, and it's yours. We do this complimentary for our callers and people that go to the QR code. And you can reach us at 844-944-7555. Again, 844-944-7555. And Cynthia, coming up in the break, we've got a commercial coming on.
Okay.
Folks, the commercial coming on is something that I do to give back to our community. I'm a very, very big supporter of a program called Mighty Oaks Warrior Program. That program is a faith-based program that's designed to help soldiers fight PTSD. And I believe very, very strongly that we live in the greatest country in the world because of the people that are out there in our armed forces and first responders that are out there putting their life on the line to make sure we're safe. And we're avid supporters of the Mighty Oaks Warrior Program. I invite you to be the same.
Ryan, thank you so much. Peter, thank you so much. To the viewers at home, the phone number to call is on your screen, 844-944-7555. We'll be right back after this very special video break.
Many of our veterans feel they need to fight their battles alone. This self-isolation has led to the staggering statistic of more than 20 veterans taking their lives every day. The mission of Mighty Oaks is to eradicate the veteran suicide epidemic and help our warriors change their legacies. We've been able to help over 4,000 veterans and first responders by equipping them with the tools they need to live the lives they were created to live. Our faith-based, peer-to-peer approach has one of the highest success rates of any program available today, offering hope and understanding to those who need it most. By aligning their lives to biblical principles, these men and women are able to lead their families, their communities, and our nation. It's your generosity that can make a difference in the lives of the men and women who have fought for our country and our freedoms. Now that they're home, don't let them fight alone. Learn more at mightyoaksprograms.org.
And welcome back to On the Money. My name is Cynthia DeFazio, and I'm joined today by Ryan Wheless and Peter Lott of Allied Wealth. First of all, I must say, I love the video break that we just played, obviously. That's such an important component, really helping and giving back. Ryan, why are you so passionate about that cause specifically?
Cynthia, my dad is an F-14 pilot in the Navy. My brother's a warrant officer in the Army. I didn't get to serve in the military. I wanted to fly jets off an aircraft carrier, didn't get to do that. But you know, I think that happened on purpose, and the reason why it happened is I now get to serve our veterans. And I do that by helping raise money for the Mighty Oaks Warrior Program and support them. You know, we do pay for this airtime, and I'm glad to give that airtime to those guys. They'll be a part of our show going forward. Every single Sunday, those commercials will air, and we're just avid supporters. And they have helped over 5,000 soldiers that are suffering from PTSD find the right path. We had a period of time where we had nobody committing suicide. And people don't know that 20 U.S. soldiers a day take their life right here on U.S. soil as a direct result of PTSD.
Wow.
And so if I can help combat that, my goal is to get that number to zero, right? If I can help combat that and help use the blessings that I've been blessed with to kind of give back and help with that community, we're all for it.
Wow, Ryan, thank you so much. And Peter, what an amazing video. Thank you for sharing that
Our
with
absolute
us.
pleasure.
Thank you. So I want to talk a little bit about average rate of return. Can I live off an average rate of return, Ryan? What's your thought?
Let's do some quick, easy math. All right.
No.
I like easy math.
I walked right in.
This is easy.
Walked
okay.
right into that one.
So I'm going to give you $100.
Okay.
All right. We're going to invest that in the stock market.
Okay.
All right. And all of a sudden, the stock market crashes, and we lose 50%.
Okay.
How much do we have left?
Only 50%. $50.
$50.
That's it.
All right. So next year, the stock market roars back and goes up 50%.
Okay.
Your money's still in the stock market.
Yep.
All right. So it goes up 50%.
Yeah.
How much do we have now?
$750.
$75 or $750. Yeah, you're multiplying there,
I'm
right?
bracing myself.
Yeah. So, but here's the thing, right? So your average return of down 50 and up 50 is a 0% return. So if I have a 0% return and I started with $100,
Yeah.
shouldn't I still have $100?
You would think.
But you don't, because you went down 50 and up 50. Your average return is 0, right? Here's what's crazy. People are focusing on average return. Hey, I can get you this average return, Cynthia. Let's see, this thing did 8%. This is what it did. And you can't spend an average return, because in this scenario, your portfolio value, you started at $100. Your average return is 0, and you only have $75 left.
Wow.
Right? And so it's one of these things that we have to teach the folks at home is there's something called compound annual growth rate. Yes, folks at home, I know that's a big word, all right? But you can actually spend compound annual growth rate.
Okay.
For instance, I can show you two portfolios, both with an 8% return, and one has a lot more ups and downs than the other one does, all right? And so over a 10-year period, $1 million in these portfolios, and the one that's more up and down will grow to about $1.7 million. All right. Well, the other one that's more consistent, even though the average returns are the same, grows to $2.1 million.
Wow.
Right. And that's how important it is. And that's a massive difference, especially in your golden years. So, folks, you're sitting down with somebody and talking about, selecting investments and picking funds and who's going to manage your money and that sort of thing in your golden years. Make sure you're focusing on what you can spend. And that is not the average annual rate of return. It's what the money actually in the portfolio creates dollar-wise, what it grows to. And it's such an important factor that so many people they don't even know about asking this.
Yeah, absolutely. So that ties into rebalancing a portfolio, correct, Peter?
It does. It does. Because you're able to rebalance it often instead of just a static approach to where you buy and hold these investments. I call it the buy, hold, and pray, where you just buy, hold, and you pray these things go up.
Throw some money at it and
throw some money and keep throwing more at it, but you can't always do that, right? But if you're rebalancing the portfolio through tactically managed money, you tend to be better off on the long term and the short term too, because you don't have to come back from the big losses. If you have to come back from a major loss, you got to have that much more return just to get the funds back.
Okay.
And that can be tough to do.
Amazing. So how often do you recommend that people come in to sit down to take a look at what they currently have in place and if it needs to be adjusted?
If they're not with us, they should come in today, for sure. Our clients, typically what happens, Cynthia, is that we understand at Allied Wealth the biggest value that a financial advisor can bring to a client is not returns, it's not performance. It's communication.
Yeah,
that is the
that's
number
true.
one reason why a client will leave a financial advisor is lack of communication. So it's super important to communicate well and communicate often. And we do that at Allied Wealth. And our clients literally get a weekly email to show them exactly what their performance was that week. And I get those emails, by the way. They come out on Sunday, okay? And if any client's like, oh, Ryan, this week was tough, I'm like, well, here's kind of what's going on. And I personally respond to every single one of them. And our clients are connected to us in that way. They appreciate it very much. And that's one thing that we do. And then as far as seeing clients on a review basis, we used to see clients once a quarter. And it was like, there's really not much to talk about every quarter because things just don't change that much. So we typically do annual reviews every 6 months with our clients. But if you're somebody who is watching the show today and you're thinking to yourself, I'm wondering how much risk I'm taking in my portfolio, pick up the phone and call us, because don't wait until it's too late to find out that, hey, I didn't know this portfolio my money's invested in could have lost 30%. Because what that's going to do is trigger a lifestyle change. And if you're somebody who wants to seek to take a lifestyle change off the table in your golden years on a most permanent basis, you should pick up the phone and call 844-944-7555. Hit the QR code in the bottom of the screen. Go to onthemoneytv.com. Again, onthemoneytv.com. All ways to reach us, and please support the Mighty Oaks Warriors programs.
Ryan, thank you so much. Peter, thank you so much. To the viewers at home, thank you for watching. Be safe, be happy, be blessed. We'll see you next week.